With immense concern over Europe arising and more bailouts being envisioned for many more countries, South Africa's growth prospects remain limited. The gross impact of the East and trade with Europe and Africa remains a matter of concern. Great Recession of 2008 is considered to be behind us, but what are the effects of that crisis? Are they still being felt, and where and how? Joining me now for an economic overview and outlook is Nicky Wiemar, who is Senior Economist at Nedbank. Hi, Nicky.
Hello.
Well, we've got all these European things swirling around, and we've said how it tends to be bumping along. People are looking for direction. So maybe it's a good time to stop and take a snapshot, which is what you did this morning, a big presentation, as you do occasionally, both globally and in South Africa. So broadly, before we look at a couple of your graphs, what was your message?
My message is that the world really is still trying to digest and overcome the difficulties that caused the financial crisis in the first place, in the Great Recession of 2008-2009, and that the excesses and imbalances that triggered that very traumatic financial crisis and also that recession were massive. And consequently, in order for the world economy to overcome this and therefore be in a more sustainable position to grow, it was never going to take just a quarter or two. And the legacy of that still continues. And the European crisis, to a large extent, is just an extension of that. It is the result of what it took, the cost, that was incurred to actually get out of the recession, and that left a mountain of public sector debt that they now are trying to deal with in a very complex system, and that they are not just one sovereign, they are 17 that have to find the route forward.
And we talked earlier about the President of the European Commission saying we need a single banking system. So we are in a bit of a no man's land, because on the one hand the politicians can control some things and then the banks have other responsibilities.
And ultimately the citizens also, what is their tolerance to in order to go through this very difficult period? We've seen in Greece that there's certainly austerity fatigue that have set in. There's growing revolt and resistance against suffering really and being imposed upon them from the outside. So that's the other side of it. Citizens might vote in a way that is very much anti-European or anti-Euro and anti-bailout, and the terms of the bailout might as a result be rejected. So as much as at a central level they may agree on the route forward, it isn't just dependent on them.
The other thing is that in the previous crisis you had governments weren't in trouble, banks were, because they'd done dubious things with subprimes and rubbish properties and things like that. Now they're both in trouble.
Exactly. Well, you still have the legacy of that debt, which of course was household sector debt. Banks are in better shape in the US. They certainly have improved their balance sheets. They are in a stronger position. They've restored their capital adequacy. Of course, lending conditions remain very tight, and it will probably be the case for quite some time. The problem, though, in the world economy is we lack an ultimate consumer. And the ultimate consumer always used to be your advanced economies. They are still 3/4 of global consumption, and consequently we need them.
Let's pause there and look at one of your graphs that you did in your presentation this morning. This is globally. We normally talk about it in South Africa. Household debt is a percentage of household income. Just take us through that and what it means.
Well, basically this is really the drag on the world economy, and it affects what is really the world's consumer, which is your advanced economies households. And you can see what caused the global financial crisis. If you look at the United States and if you look at the UK, it was a massive build-up of debt in your household sector, and that was of course the result of a very long spell of extremely strong economic growth associated with rising asset prices, and consequently people started to spend and borrow in an overly confident fashion, and sometimes even a reckless fashion. The net effect of that, of course, was this dangerous build-up in debt. Interest rates went up. That triggered the defaults of the global financial crisis, but it still remains high. Now you can see both in the case of the UK and the US, it peaked at really astronomical levels. Remember, 60% is like sustainable. It's not even on that scale.
We're around 40, aren't we?
No,
we're around
75.
75, that's right.
Yes, we're around 75. So it peaked at, in the case of the UK, at 175% of disposable income, completely maxed out. In the case of the US, at 130. Now they have been repaying their debt, but it's a long and slow and painful process. and so consequently you have an impaired consumer. Therefore you have an impaired source of final demand in the world economy. And that's why the recovery has been so patchy, so frustratingly slow, and so stop-start of nature.
You also talk about government debt as a percentage. You've just mentioned it now. Japan's still way out there at 235% of GDP. Then Greece 153, Italy 123. They say that's the next one. Ireland, Portugal, the US 106. That's come down, as you say. The UK 88, and we so. Talk about those.
Well, this really is the result of trying to get out of that very deep slump caused by private sector debt. So in order to get out of the slump caused by private sector debt, they basically had to stimulate their economies. They undertook aggressive fiscal stimulation. They gave tax relief during the recession when their tax revenue was shrinking. They accelerated government spending to compensate for the fall off in the private sector. And in the end, what we saw was that their government expenditure exceeded government revenue by large amounts, on average between 8% to 12% of their GDP.
Now, so you have got South Africa there at 40. So what was I thinking? The percentage there, the bottom four are in green.
The bottom four of green, those are emerging markets. So you've just an example of that. Emerging markets still remain well below that sustainability cutoff of 60%. So your sinners really are overwhelmingly your advanced economies, and your saints, if you want to put it that way, are your emerging markets. But what this essentially means is that you now have a deleveraging in the private sector. At the very same time, you have a situation where the markets are no longer willing to tolerate these high public debt burdens, and consequently you now have the beginning of deleveraging in the public sector. So the combination of that is very negative for growth. It's very growth sapping. And if we're lucky and we can manage confidence throughout the system, throughout this period of adjustment, we might tweak out a little bit of growth, but it's going to be modest growth. And if we're not lucky and it's done in an unorganized and chaotic and patchy fashion as we're seeing in Europe, we'll sink back into recession.
What about our exports? And you've come up with some interesting trends there. And we're talking about how exposed we are to Europe. And I think one of the figures mentioned was 50% for the platinum industry because of the car industry there.
Absolutely.
But how exactly are we exposed to Europe? And where are our exports going? And how does it affect how we must look at these things?
Well, Asia has grown dramatically, especially for mining. It's over 40% of mining exports go to Asia now. But Europe is still a significant chunk of mining exports. It's about 20%. But if you look at all the sectors, agriculture, mining and manufacturing, you've got about 25% of total exports going to Europe. Now that is substantial.
Now look at there's some quite dramatic changes there, going from 1998, so that's 15 years we're talking about. Exports to Asia have gone from 15% of the total to a third.
Exactly, and it's enormous. And so that also reflects to some extent the rise of China and its significance in the world economy, but also the troubles that we have seen in advanced economies and consequently their diminishing share of world output.
And if you look at the reduction there from Europe, it's nearly 40% down to 25%,
That's
although
right.
It's all interlocked. I mean, we can't say, oh, therefore it's okay.
Quite frankly, yes. Because if Asia did what they did in 2009, where they saw their exports come under pressure because of the pain that was advanced economies were going through, especially their biggest trading partner, the US, and they announced this another $600 billion infrastructure package, and they start building little cities and 10-lane highways from nowhere to nowhere.
Bullet trains everywhere.
Bullet trains everywhere. If they repeat that, you know, then you'll have another surge in demand for commodities, and we'll probably be okay as an emerging market because we are, of course, a producer and exporter of commodities. However, most people agree that China won't do that. They already have elements of bubble-like characteristics in their commercial property. What they might do is stimulate domestic spending, so encourage their consumer to spend, which would also be good and help offset some of the pain coming from Europe. But they're also going to feel that. And I think we've seen in the latest indicators coming through that China is also slowing. And unlike 2009, they're perhaps willing to sit the slowdown out, just stimulating a little bit within their domestic market to keep growth above a certain level, but not giving the world that oomph it gave the world back in 2009.